On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Term deposit rates have fallen sharply over the past several months. After hitting 15-year highs of more than 6% last year, today they're sitting in the mid-fours. They'll keep going lower too, with the official cash rate, the OCR, likely to be cut by another 50 basis points this month and at least a couple more smaller cuts to follow. This puts conservative savers in a difficult spot, especially if they're uncomfortable moving up the risk curve into shares or property. Enter fixed income. Commonly referred to as bonds or debt securities, fixed income is the cornerstone of many an investment portfolio. It offers a predictable income stream and it's typically much less volatile than higher growth asset classes. Fixed income refers to investments that provide regular interest payments or coupons and they return your principal at maturity, so you get back what you put in at the start. When you invest in fixed income or purchase a bond, you're essentially lending money to an entity. A government maybe, a company or corporation, maybe even a local council. And in exchange for lending them that money, you will receive those interest payments. Bonds share many characteristics with term deposits, although they can be traded on the open market, just like shares can, and that means the prices will move around. Fixed income or bond prices move inversely to yields or interest rates. What that means is that when interest rates rise, the value of existing bonds falls because they look less appealing than the new bonds which are being offered at higher yields. That's what happened in 2021 and 2022 as the OCR was rising from those very low levels we saw during COVID-19. Importantly, bond investors still got their capital back upon maturity though, so even though those prices fell in the meantime to reflect the opportunity cost of higher rates on offer, you still got back what you put in. Conversely, if interest rates are falling, like they have been lately, existing bonds that were issued when interest rates were higher start to rise in value. Many fixed income investors will ladder their investments by owning a range of bonds to spread out their interest rate exposure over different rates and different maturity timeframes. Fixed income is generally lower risk than shares or property, and that's why it offers less growth and more modest long-term returns. However, it's not risk-free. Lower risk doesn't mean free of risk. In addition to the impact of changing market interest rates, fixed income investors need to also consider credit risk, and that means the likelihood that the issuer will default on its payments and not be able to pay you back. A government or a council is a pretty safe bet. Those sorts of entities can levy taxes or rates to increase their revenue and pay their interest bill, so they're fairly safe. But a company can run into trouble if it encounters difficult times. That's why corporate bonds typically offer higher yields than government bonds, because you're getting additional compensation for that slightly higher credit risk. And that's why a fixed income investor needs to think really carefully about the issuer and about its credit rating, because you're lending money to them. You want to make sure that they'll be able to pay you back when that investment matures, and you want to make sure that you'll get those regular interest payments as you're expecting. Liquidity is another really important factor to consider. That means the ease with which you can buy or sell something. Some bonds can be quite difficult to sell, especially in times of volatility or market stress. Bonds from smaller companies don't always have a robust secondary market compared with highly liquid instruments like New Zealand government bonds. The structure of a fixed income security can also be important, and that can change the risk profile, so this is something else you need to consider. Subordinated offerings and hybrid securities, they sometimes require a little more inspection, and you need to think a bit more carefully about whether they're right for you. These can offer higher yields, which is more appealing, but they do come with more risk. Subordinated means that this type of debt ranks below other instruments in terms of its repayment priority. So if the issuer or the company that's issued those bonds hits financial trouble, subordinated debt holders will only be paid after the more senior debt holders have been fully compensated. So you're lower down the pecking order. Hybrid securities, they pay interest like a bond, but they also have some equity-like traits, which make them look a little bit more like shares. Some of them have the ability to convert into shares under certain circumstances, and others might have clauses that will allow payments to be suspended, should that business or that company run into some financial stress. These sorts of securities usually do offer higher returns, and that can be a really useful way to boost the yield across your overall portfolio. However, you just need to understand that they do come with more strings attached, and that makes them a little bit more complex. Subordinated and hybrid securities are often less liquid than government or corporate bonds too, which means that selling them can be difficult, or that prices can sometimes fall to reflect a wider spread between buyer and seller expectations. Fixed income can provide investors with a stable, reliable, predictable income stream for a modest level of risk. So if you're staring down the barrel of sliding term deposit income, it might be a really good solution that is worth a look. For most private investors, a mixture of New Zealand government and local authority bonds combined with investment-grade corporate bonds is the optimum approach. Subordinated and hybrid securities can be a useful complement, but just make sure that you understand the nature of these and keep your weightings in check. You don't want too many of those across a portfolio. For smaller investors, diversified fixed income or bond funds can be a really good option. They can immediately mitigate the risks of interest rate changes, creditworthiness, and liquidity, while they offer instant diversification. If you want to know more, talk to your advisor. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.